Hello, happy Sunday, dividend growth stock investors. It is Colby, the DGI Crab, coming at you here July 13th, 2025. It is time to build up the tension in your dividend portfolio. What am I talking about exactly? Well, if you are a value driven dividend growth stock investor the way that I am, you are happy to continue to build up positions in quality companies while they are down. The longer that they're down, the more time you have to invest new capital in those positions. And when they recover, what those possibly larger positions you've ended up building in your portfolio will have a massive impact on the overall value of said portfolio. But we're all about the dividends here and trying to attain enough passive income to attain financial freedom only by focusing on 60 of the highest quality dividend growth stocks combined with some ETFs. So that way we are only adding top quality blue chip companies, but your age and timeline are the most important part of your dividend journey. So I've split this into 4 separate categories or tiers based on your age. I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes. I am merely sharing my personal strategy with you. Maybe it'll give you some ideas for your own portfolio, but the way that I do things around here is every week when I invest my money, I put 50% of it into age appropriate ETFs for automatic diversification. I'm targeting single stocks that are yielding 30% or more above their 4-year average yield, so long as they're primarily the ones that are just within my own stock grouping or age tier. I do put a special emphasis on my personal top 10 favorite dividend growth stocks. I'd like to get them at a 20% discount, but I might not always wait for that if I just want to add a little bit to my positions. Those are a group of 10 that I basically don't worry quite as much about the overall value because I want to make sure I've got a fair amount of those in my portfolio. I'll go outside of my own age tier if there's a stock yielding at least 50% or more above their 4-year average yield, because I think I'm going to be getting, first of all, a lot more yield for my money, hopefully better long-term dividend growth, and certainly, as I pointed out at the beginning, the potential for a lot of price appreciation in the long term. And I do buy just more ETFs in a given week if I don't like what's available to me, or if there's not anything that's of a particular value within my own age tier. So we'll jump on now into the spreadsheet and take a look at the tiers, see what is undervalued for the week. We'll start here in tier 1, the age 18 to 30-year-olds investor. This group of stocks is going to be a smaller yielding group of stocks, but as a collective here, we want them to average well above 10% year over year dividend growth. Because if you're 30 or under, you don't need to pile up a bunch of dividends early. You want to pile up a bunch of stuff that's going to grow dividends quickly. You don't want to be paying taxes on all of your dividend growth that you're getting through the higher yield stuff, because DRIP is the only way you get there with the high yield stuff. You don't want that tax implication while you're young. So build up a nice pile of stuff that's going to low yield initially, but grow really fast over the long term. United Health, Nike, and Nordson remain the 3 stocks in the buy zone for this category. And this valuation metric is just me looking at the 4-year average yield, comparing it to the current day yield. It's as simple as that. UNH, the most undervalued stock among all 60 of the stocks of the channel. Full disclosure, I bought UNH pretty heavily this past week. It was the single stock I invested in the most, followed up close second by Pepsi. We'll get Pepsi here in a little bit, but UNH, I am happy to continue to buy that one. I hope they stay down here in the $300 range for the rest of the year, so I can build up a very strong position there. So when it gets back to being a $600 per share stock, don't know when that's going to happen, but at some point in the future it will. I like to have my dollar cost average down here in the low $300 range. And yeah, Nike and Nordson still looking like good quality buys at this point in time. If you're still adding to Nike and Nordson, I salute you. I think you're going to be happy with both of those in the long run. Tier 2, age 31 to 41-year-old investors. This tier, the yield is going to be anywhere from 2 to 4%, depending on what it is you're buying when you're buying it. As a group, we want high single digit annual year over year dividend growth, 7, 8, 9%, somewhere in there. Only two in the buy zone this particular week, Target and Hershey, but both of those not only hit that 30% mark, but they're at the 50% or more mark, along with UNH and Nike. Target and Hershey are good to go as buys, if you ask me, regardless of how old you happen to be. Hershey, I think, is getting closer to a recovery story. They get up into the $170 range pretty consistently. They fell back down late in the week to 164. I think Hershey is going to be back up in the $200 range before we know it. They just need to catch a break on some lower cocoa prices. And then Target, the yield is high right now. I think that the yield growth is probably going to be pretty slow for the next few years. It's just speculation on my part. But you can certainly get paid a nice starting yield to wait for that dividend growth to return. In the meantime, when my dividend reinvestment for my target position hits, I've been so happy about it because it's just buying me more shares at that excellent mid 4% starting yield. So that target position is growing itself pretty nicely now with that drip as well. Keep your eyes on McCormick, American States Water, and NextEra Energy. All three of these stocks have been flirting with buy zone category. All of them are in the $70 range share price. So the closer down to 70 we get on all three of those, the more attractive that they look. McCormick very close to buy zone, but I'm going to be kind of a stickler about these. If they're not in my personal top 10 favorite, they're just within my tier. I am going to wait until they at least hit that 30% mark. I want my dollar cost average to be as low as possible on any single stock. Tier 3, age 42 to 53-year-old investors, more stocks in the 3 to 5% yield range. We want mid-single digit dividend growth, around 5-6%, hopefully in most years. We have Pepsi, Archer Daniels Midland, and Hormel as our three buyable stocks once again in this tier. Pepsi, because it's one of these here in bold, does just so happen to be one of my top 10 favorite dividend growth stocks. So I continue to add to Pepsi very consistently week over week, especially with that yield above 4%. Very happy to add to my Pepsi position with that high of a starting yield. Archer Daniels Midland had been down below $50 a share for quite a while. Still attractive to me here, even in the mid 50s. I like that starting yield in the high threes. It was even better when it was above 4%, but still it is far above that 4-year average. Still just a stock where that 4-year average is 2.64. So 3.71 starting out, a full percentage point plus higher. I'll still take that all day. And then Hormel, still hanging around in that buy zone, but I do keep saying, guys, week in and week out, every time I update that 4-year average yield each week, it's a basis point or two higher, and the starting yield has been sitting here in the high threes for, about a year now, and that's starting to become more of the norm than the aberration. So eventually here, maybe within the next 2 or 3 months, if Hormel just stays here right around $30 a share, the 4-year average yield will have continued to climb enough that it'll push it out of the buy zone. And listen, getting Hormel in the high threes, I still think is a pretty solid move. But until they're able to get that payout ratio down a little bit, their dividend increases just may not be as much as we want them to be for the next year or two. Just have to see how they work through being down here for a little while. Haven't lost any confidence in them as a company. I don't think their dividend is in danger, but this just used to be one that grew quite a bit year over year, and they're going through a slower period right now. Tier 4, age 54 and older investors, we want 5% or better starting yield for the most part. Still want 2 to 4% annual dividend growth year over year. The high yield stocks remain very much in vogue. There's nothing here out of this group of 10 that looks even remotely buyable for me right now. So for this particular group, we'll definitely be focusing more on the ETFs. Very quick stop by the top 10 tab. These stocks are all found somewhere between tiers 1, 2, or 3. This is just my personal top 10 favorite group here. So I'm not always looking for the biggest bargain with this particular group. I'm just looking for a deal I feel pretty solid about. Pepsi for sure is one I like right now. J&J I've been adding when it's down more like in the lower 150s. Procter & Gamble, I'm keeping a very close eye on now. 11% off the 4-year average. Certainly one that I like to buy when it looks like it makes sense. Procter & Gamble, if I could get that even down to about $155, I think that's just about good enough for me to maybe trickle a few dollars in there to add to the position that I've already got, which is not as much as I'd like right now, but I'm still not quite at that tier 3 level yet. I'm going to turn 42 later this year, and the tier 3 stocks, which is where Procter & Gamble is, are going to be ones that I start emphasizing a little bit more. But I'm certainly never opposed to adding to Procter & Gamble, especially when that current yield is at least fairly comfortably above the 4-year average. I don't want to buy it when it's below, because the growth rate on it's not amazing, like 5 or 6% a year. It's what you want in this group, but I like to at least get 15%, if not a 20% discount on this one. But keeping a very close eye on PG. Are any of you guys buying PG right now? Let me know down in the comments below. All right, and then let's just run over allocation strategy. This is what I would do in each of the tiers if that was where I happen to be in my age range. Tier 1, I'm going to put half my money into this group of ETFs. I want 25% S&P 500, 15% small cap, 5% VIG for dividend growth, 5% VYMI for international investments. For tier 2, same 4, different allocation weighting. VIG becomes my primary emphasis in the tier that I'm in right now. I continue to build my VIG position every single week like clockwork, along with adding some more to the S&P 500, little bit into the small caps, and then international once again. When I graduated to tier 3, 42 to 53, I love all 3 of these ETFs, SCHD, VYM, DHS, differing strategies, all very quality results. And then tier 4, I recently updated this one. It used to be 8 ETFs. I've split it now into 10. 5% allocations into each. I talked about that in the video yesterday. Go check it out. But SPYD for higher yielding stocks in the S&P 500, SPHY for high yield bonds, preferred shares, PFFA, MLPX, MLPs, IYRI for real estate, BTCI for Bitcoin income, DevoJEPQ SPYI are my covered call trio, and then VYMI once again. And because there's not anything in that tier 4 category that looks appealing, I'm going to double down and do 10% across the board in these ETFs for tier 4. With the exception of VYMI, I keep my international strictly at 5% across the board. I would throw a 5% allocation once again at Pepsi, even in that 54 and older category. And then for tier 1 on the stocks, my other 50%, I'm going to prioritize Pepsi, UNH, and Nike. And then Nordson, Target, and Hershey is my next man up. Tier 2, Pepsi, Target, Hershey, UNH, primary focus, maybe a little Nike in there too if I've got a little 5% left over. And then for tier 3, Pepsi, ADM, Hormel, Target, Hershey, UNH, Nike. Hopefully that breakdown for all of those makes sense, you guys. The stuff in your own tier first, followed by the stuff in different tiers that have a 50% or more dividend undervaluation mark. Let me know in the comments below what you are buying this week. Email me your questions to dgicrab@yahoo.com, and let's build up the recovery tension, the potential for that massive recovery by adding to these stocks when they are down. I will see you all next time. Keep on investing.